and welcome to another cozy, charming, crazy real estate where we talk about everything real estate. Today we're going to talk about the 10 most common real estate contract contingencies and how you can use them whether you're a buyer or a seller. So let's get started. So first, what is a contingency? Well, it's simply a clause in a real estate contract that allows either the buyer or the seller to change or terminate the contract if they run into a specific situation or condition. So how do contingencies begin? Well, most contingencies are actually written into the purchase offer by the buyer, and therefore they are included in the original contract. Or they can be added by mutual consent of the buyer and seller during escrow. So how do they end? Most commonly, contingencies are released by signing a contingency release form. The buyer and the seller both sign, saying that the situation or inspection or whatever the contingency is, the conditions have been met, and so that contingency can be released or ended. Or it could be that during escrow, the buyer and seller, by mutual agreement, modify the contract just to get rid of the contingency because they find they don't really need it. And finally, there are some contingencies that run all the way up until the day escrow closes. So actually closing the contract closes out those contingencies. There are 5 categories of contingencies that we're going to cover today when we look at the 10 most common. And those categories are finance, inspection, insurance, title, and contract. Finance contingencies are mostly mortgage and appraisal. Number 1 is appraisal. A typical appraisal contingency might be the buyer requiring that the appraised value of the property is at or above the purchase price in the contract. Now, the mortgage and deposits section, or sometimes it's simply called finance contingency, is based on the need of the buyer to be able to secure a mortgage and general financing conditions that they can actually live with. And they might say, okay, I'm going to put down so many dollars in an initial deposit, maybe I'm in an initial deposit, and then they're going to make additional deposits during the escrow period, especially if it's a longer escrow period. It could be that the buyer needs to get a mortgage amount of a specific amount or above, and so that's going to be a requirement that must be met or they have the right to drop out. And it might be that they want to be able to get a certain interest rate or lower in order to be able to afford this mortgage, and they might need terms such as maybe a 10-year, 20-year, 30-year, whatever they specify in the payoff of that loan, whether it's being able to pay it off early as an option or having to pay it off early as a balloon. All those things can be quantified in the original purchase offer as a contingency by the buyer. Inspection contingencies are very straightforward. It could be that the property is pretty simple and requires just a simple structure or main structure inspection. Could be if there is a well, you might want a special well, septic, sewer, roof, electrical, any number of different inspections. If the buyer knows that there are certain repairs that need to be made, those repairs could be identified as contingencies in the contract. So you might have a repair contingency. And the final is a land survey, which is a form of inspection, but it's a little deeper. Not only will a survey mark the boundaries of the property by using stakes at the corners, perhaps some orange tape marking the boundary lines, or perhaps paint on the ground, but most land surveys will also help to identify any encroachments. And encroachment can go both ways. It could be that the seller of the property has, let's say, added a storage shed. They didn't confirm the boundary line, and half that storage shed is actually located across the boundary on the neighbor's property, therefore creating a liability to get rid of that, to move it back off the neighbor's property. And it could be that the neighbor is the one who has built that shed. And before you close escrow, if you're a buyer, you might want to make sure that that encroachment is remedied, that that shed is moved. Insurance contingencies, simply the buyer wants to make sure that they can get the insurance that they require specifically for that property. Now, there's generally, if they're going to have a mortgage, there'll be the fire and environmental damage, certain coverages that the mortgage lender requires. The buyer might also want to be able to get personal property and liability insurance, but also if they intend to use the property for any kind of a business or commercial use, they want to be able to make sure that they can get insurance for those kind of activities. Title contingencies can be kind of messy, but they're very necessary. First is that you must get clear title to a property when you buy it. Title defects are unfortunately more common than most people think. It could be a misspelled word in a deed or a legal description. If such a thing exists, it must be discovered during escrow and fixed. Could be that easements are identified in the title report. These are the rights of neighbors to come use your property. Classic and easy example being the right of a neighbor to drive across your property to reach theirs. So if there are easements that allow others to use your property, you definitely want to know about them if you're a buyer. Buyers also want to know about liens. Now, liens can be recurring, such as simple property taxes. And if you're in California, mellow roost taxes, which can either terminate on a specific date, or some mellow roost taxes go on forever. Or they can be non-recurring. And a simple example might be of the seller of the property had a judgment against them based on any kind of disagreement or problem that they had with someone else. And when they went to court, that judgment against them was secured by a lien against their home. And that would be a non-recurring lien that would need to be satisfied either prior to closing escrow or as part of escrow. And that would be definitely a contingency a buyer would want. Another significant thing that comes out of a title search are entitlements, and that is the land use and zoning for the property, plus any requirements from CC&Rs if there is a covenant or homeowners association, HOA, especially if the buyer wants to use that property for a use that is not allowed by land use and zoning requirements or CC&Rs. They need to know that. And that should be a contingency for the buyer. Contract contingencies make up our last category. Now, the sale contingency could be that the seller is going to say, I'm going to sell my house, but closing escrow is contingent upon me being able to buy another house that meets my needs. Now, on the buyer side, it could be, I am making an offer to buy this house, but I will only close escrow once I am able to sell the house that I currently live in. So those are very common contingencies when the market is tight. And by tight, I mean there are not a lot of listings for sale. So either the buyers or the buyer may have a hard time finding a buyer for his house, or the seller might have a hard time trying to find another home to move to. So both of those are sale contingencies, and they can be written up to say, I must buy or sell a property within so many days, or it could be that escrow is agreed to be left open for a very long time or undetermined time to allow both sides to be able to clear those contingencies. Number 9 is the ability to assign, and we talked in our last episode about wholesalers, and wholesalers purchase property, and as soon as they get you into escrow, they're going to go out and try to find an investor to buy it from them, so that they never take title on escrow closing day. That contract is assigned to an investor. So if you have if you are a seller and you get an offer that says, well, I have an assignment contingency, you're probably talking to an investor, possibly a wholesaler, and you'll want to consider, well, do you really want to accept an offer with an assigned contingency? Now, number 10 is one you don't see very much, but if you are a seller and you get a purchase offer from a buyer that includes a buyer sale contingency, and that's when they must sell their home in order to buy yours, I always recommend a kick out contingency. Now, a kick out means I'm going to kick you out of the deal and I'm going to replace you with a better offer. So in the scenario of a kick out, you agree to a purchase contract with a buyer, but it's at a certain purchase price. Well, someone comes along and offers you a higher price. If the buyer that you're in contract with now does not meet that price, you have the right to go ahead and cancel that purchase contract and accept the higher offer. So it can be very handy for sellers if they don't want to have that property tied up with a lower offer because of a sale contingency. So those are the 10 most common contingencies. You don't see one that you're thinking about needing or that you might need here, ask your broker or ask an attorney. All clauses are legal statements in legal documents, and therefore should originate with an attorney. Even if you get them through your broker, it is very common for brokers to go to their attorneys and request special contingency clauses or any kind of contract clause that they intend to use over and over again, and their attorney will draw up something that they can use over and over again. Or if they have a special need, a broker will typically, rather than writing that clause themselves, they will ask their attorney, and rightfully so, ask their attorney to write that clause for them. So I hope you found this interesting and helpful. If you like this video, please hit like. And if you have any comments or questions, please leave them below. And I hope you will follow or subscribe to Cozy, Charming, Crazy Real Estate, and catch us next week. Until then, stay well.